Everyone. Welcome to today's online webinar here with Quest Trust Company. I am super excited to have with us today Devin Elder, a multifamily investor based out of San Antonio, Texas, here today with us to really dive deep into some multifamily case studies. So if you guys have watched our webinars before, you know we bring in a lot of different guest speakers. We like to cover a lot of different topics. And if you want to rewatch today's class, you can head on over to our YouTube channel and rewatch today's webinar, as well as every other webinar that we've hosted here in the last several months. For those of you guys who don't know me, my name is Haley Gant. I am one of our IRA specialists here at Quest, and I basically work pretty closely with the rest of our marketing team to help to put on all of these events for you guys. Right now, they are still all online, but we are looking to bring back our in-person events here in the month of August. We are super excited about that. So if you've been joining our webinars and you're based in Houston, Austin, or Dallas, be sure to check out our upcoming events on our website and our newsletters. We'll have some really exciting announcements coming up for you guys soon. Now, before we get into today's main presentation, I do just have a couple of quick slides. I know in our webinars, we get a lot of new people that join us every single week. So if it's your first time joining us, first of all, welcome. I hope you enjoyed today's class. Again, this is just one of many classes or webinars that we host, and we have a lot of other great educational resources for investors out there. So quick little tidbit here, who is Quest Trust Company? We, at our core, are a self-directed IRA custodian. So we basically teach investors how to utilize their old 401ks or IRAs to really truly diversify and invest into assets outside of the stock market. So where most traditional custodians like Fidelity, Charles Schwab, they only allow you to invest your IRA funds into publicly traded assets. Where at Quest, we actually do the exact opposite, where our clients invest their IRAs into real estate, promissory notes, multifamily deals, and other types of privately held assets. So a lot of times this is a new concept to a lot of people. We do a lot of education, and we have several other IRA specialists on our staff as well that are really here to connect with you guys one-on-one, help to walk you through this process of how investing with a self-directed IRA works. So be sure to keep an eye out at the end of my slides here. I'll have our contact information of further ways that you can reach out to us. Now, we're a pretty good sized company. We have about $2 billion in assets under management. The reason why we always kind of like to touch on that is because all of that $2 billion in assets under management is all privately held assets that our clients have self-directed and actually chosen the types of assets that they want their IRAs invested into. So again, a lot of times this is a new concept to a lot of people, but there are a lot of people out there doing it. At Quest, we make the process very easy for you. We walk you through the whole logistics of the process step by step. And we have a lot of people on our staff, about 100 employees across Texas, but we do work with clients all across the country, and we operate in all 50 states as well. Now, last but not least, the most important bullet point on this slide here is our disclaimer. Please be aware that at Quest, we do not give tax, legal, or investment advice. We provide a lot of education. We bring in a lot of different guest speakers on our platforms. But all of these presentations are all strictly for educational purposes only. And it's really important that you make sure that you do your own due diligence before you enter into investments, whether it's with your own funds or whether it's with your IRA funds. Make sure that you're taking the time to vet the people that you're working with, you're doing your due diligence, and you're just taking the time to really make sure that you are structuring your deals properly where your investments are protected as best as possible. Really cannot stress that enough. But now that that disclaimer is out of the way, let's get into some of the more fun stuff that I have in my slides here. At Quest, we have a lot of different educational resources. One of the biggest parts of my job is helping to get our education out there, bringing in different guest speakers to our events, and coordinating the different presentations that we give across the country as well. So if you're interested in learning more about our different educational resources that we have, be sure to head on over to our website, our YouTube channel. Be sure to check out the other webinars that we host. We host several webinars every single week. We have a really big series on Saturdays. It's called Self-Directed IRA Saturdays, where we bring in different speakers from across the US. And these events are really popular. Again, you can always rewatch them online there on our YouTube channel. So our YouTube is a very great resource for you guys. Now, one of my other personal favorite events that we host is our virtual networking happy hour. We host it twice a month. It's completely online through Zoom. And on the first and third Wednesday, we get about 50 investors at every happy hour that join us from across the US. And it's really created a nice little kind of network and ecosystem of investors who are looking to make connections with each other and ideally add other people to your power team so you can continue to find deals in today's day and age where, a lot of us are doing most of our communication virtually now. Now, be sure to mark your calendars. Coming up this July, we have the Quest Summer Intensive. This is actually the first event that we have hosted in this format, and I am very excited for it, as I am for all of our events. But this will be 3 Fridays in a row, and each Friday we will focus in on different types of investments. The first day will be real estate, the second day will be private placements, and the last Friday of this event will be all over notes and private lending. Now, this will not be a basics event. This will be a deep dive into some higher level topics, some in-depth case studies, due diligence. And we are currently in the process of finalizing our speakers right now. So we should have that full lineup and agenda announced here in the next few weeks. But tickets are cheap for this event, $25. It is a paid event, but there is a lot that goes in behind the scenes to plan and host these multi-day events. So this one does have a small cost to attend, but you can attend all 3 days, you can pick and choose, and you can also get access to the recordings as well. Now, also, I did want to remind everyone that we have revamped our referral program this year. If you are currently a Quest client and you have people in your network, maybe family members that could also benefit from having a self-directed IRA here at Quest, be sure to refer them over to us. Make sure that they put your name on their application, and you will each receive a $25 credit to your account. And there's actually no limit to the number of people that you can refer to Quest. We do have a web page set up for this. It is refer.questtrust.com. And in this webpage, you can actually put in your contact information. We'll reach out to the person that you are looking to refer and just kind of walk them through the process, answer any questions that they have. And then once you guys are ready to get that account opened up, our IRA specialist will assist with that process as well. So be sure to check that out, earn some free credits, refer your friends to Quest. We really appreciate it. And if you have questions, definitely don't hesitate to reach out to us. We really pride ourselves on being very easy to get a hold of here at Quest. You can give us a call, you can chat live with an IRA specialist, or you can send us an email at iraspecialist@questtrust.com. You guys will also see here one of my coworkers, one of our other IRA specialists, Evan Reeves, is here on the chat with me on Zoom today. If you guys have questions, be sure to send him a message. He is here throughout the entire webinar with me here in the background to help get those questions answered for you guys. Now, without further ado, I want to go ahead and bring on Devin Elder joining us from San Antonio, Texas today. Devin is a multifamily investor, and he's here today to walk you guys through some cool case studies that I'm actually pretty excited to see myself. I love seeing what other people have going on. And Devin, the floor is yours for about the next hour. If you guys have questions, be sure to send them to the Q&A box, and I'll come back on at the end and get them all answered for you. So Devin, thanks for joining us today. I'm excited to see your presentation.
Excellent. Haley, thank you so much. Appreciate the introduction and looking forward to jumping in here. What I'm going to do is share my screen. I've got a presentation together for you guys that are on. So let's just jump in there and I will get started right away with this. We are in San Antonio and we're going to talk about multifamily. So Haley mentioned notes and private money lending and oil and gas. And these are all vehicles that you can use your IRA funds to invest in. Well, multifamily is another one. Multifamily just means apartment complexes, and that's what our firm specializes in. And we have a lot of our investor clients have Quest accounts, a lot of them. So I would probably say 20% of the capital in our projects is from IRA funds, because somebody might not have $50,000 lying around in a savings account to invest in, but they might have a lot of capital to access through their Quest IRA account. So it's a great tool, a great service for people. We send a lot of people over to Quest to get their regular IRAs converted into self-directed IRAs, and then they could put money in these types of projects that I'm going to talk about today. So we're going to talk about some case studies on projects that we bought, worked our magic on, and sold, and the returns we got for investors. And so we're going to jump into that here. We're focused in San Antonio, so you have a nice San Antonio skyline. But we're going to talk about how DJE, which is our company, managed the acquisition, repositioning, and disposition of 2,000 multifamily units, with a specific focus on a handful of deals we've done here recently. So, little bit about me. My name's Devin Elder. I'm the principal at DJE and also apartmenteducators.com, which is, we're big on education too, just like Quest. So we have a lot of educational content and programs that we do at Apartment Educators. I am in San Antonio and started this company back in 2012, and have grown that from doing a lot of houses and smaller projects to now we're doing apartment complex, 200, 300, 400 unit apartment complexes. So we're focused here in San Antonio. Just about all of our deals are here in San Antonio, and we like it that way. We like to have a handle on things. So that's just a little bit about me there. A little bit about our firm there. This is some of our corporate team here. Basically, since 2012, we've been buying real estate and adding some kind of value, meaning we might, in the old days, have bought an old house and fixed it up and sold it for a profit, or bought it, fixed it up, and rented it out for some cash flow. We really are doing the same thing today. We're just doing it at a bigger scale. You know, we started getting into multifamily years ago, a 6 unit, and then a 75 unit, 130 unit, 192 unit. And that business model has just kind of grown for us. And I believe the reason it's grown is because it's a win-win scenario, right? We can go out and do much bigger deals, 10 and $20 million projects, because we're investing in these projects, but we're also bringing investors into the projects. That allows us to do much bigger deals than we would do just on our own. And it creates a real win-win scenario, because the investors in the projects are truly passive investors. You know, your person that's retired, or they're working a day job, or they already have a successful career, they might not stop on a dime, go out and buy a big building and do all the work that's involved. That's a big step to do that. That's a full-time job that we do. But they can write a check for $50K out of their Quest IRA into one of these projects, and then they're done. And then they just get the benefits of that cash flow and the return of that project, and let the other person do all the work. They can participate in a passive manner. So I call it a win-win scenario. It's the reason we're able to just go do deal after deal after deal, because if you can structure something where everybody wins, everybody wants to go do it again. And so that's kind of the situation that we've put ourselves in here, just being San Antonio focused. And these days, I'm a principal in over 3,000 doors of multifamily, most of that in San Antonio, actually. So it's really grown. It's been a great business model. We love Texas and we love San Antonio. We'll dive a little bit more into that here. This is a look at some of our portfolio. We've got the Travis building downtown, that's 63 units, the Joseph at Huebner in San Antonio, 192 units, and some more projects. You can kind of see here that we're in for the most part, in that 150 to 300 unit range. It's really what we typically target. Most of these projects are kind of like 1980s construction, because the much older stuff, or stuff that's in a scary part of town, those are hard projects to run. And then the brand new stuff is difficult too, because they're not going to give you the returns that you want. So we like that middle part of the bell curve there. We like to have a product with a huge customer pool, right? If we can rent something clean and functional and nice, but it's not a huge expensive rent, we're just going to have a lot of people that want to live in that kind of a community. So we're going to have a lot of customers really forever. That's the thesis of of owning these kind of 1980s B and C class multifamily apartments. So that's a quick look at some of our portfolio there. Our process. So what does our process look like? And I also want to interject here. There's a Q&A box on your screen there. If you've got questions at any time, just punch them in there, and we'll have some time, I believe, at the end of the presentation here to answer those questions. So as those questions occur to you, feel free to type them in that chat box there. So what does our investment process look like? This is a very repeatable process that we've built over time. And we're always in some portion of this process on any given project. The first is really not even on here, but we're always looking, right? We're always touring deals, looking at deals, making offers. There's a tremendous amount of activity within the firm here that most of it goes nowhere, right? Look at deals, doesn't work. Look at deal, doesn't work. Numbers don't work. Numbers don't work. Make an offer, we get beat out by somebody else. Okay, that's kind of 95% of it is swing and a miss, right? And that's important. That's by design. We don't want to just go out and buy anything. We want to buy a couple of deals per year that we absolutely love and we know can perform for our investors. So a lot of work on the front end, turning over rocks, and looking for that diamond in the rough. However, a couple of times a year, once we actually do get a contract accepted, then we move immediately into our due diligence process. So we've got a very extensive upfront due diligence process. What does this look like? Well, once we get the contract signed, usually within about 48 hours, we are on site with our team at the property looking at absolutely everything. And it's not just our team. It's also going to be other vendors, right? We're going to bring our roofer out there. We're going to bring our plumber out there to run a scope down the lines and inspect the plumbing lines. We're going to bring a foundation vendor out to look at the foundations. We're going to bring general contractors out. We're going to bring painters out to give us bids on painting. Same thing goes for the parking lot. We're really going to crawl all over that property for about a day. The last property in San Antonio that we did due diligence on just a couple of weeks ago, we had about 20 members of our team on site. And so that team broke up. Some folks went in the office, and we do what's called a lease file audit. So we look at literally every lease on the property. We review it, we catalog it, and we look for patterns in terms of how the property is performing, who's living on site. So very thorough audit there. We also audit the financials of the project. And then we walk every unit, every single unit. So we break up into teams. Everybody's got clipboards, and everybody goes into every unit on the property. A recent project we looked at was 400 units. So that one took all day to get inside every single unit and take a look at the condition. And what we're looking for is, what is the current condition and what's it going to cost to renovate the unit to the standard that we want. So very exhaustive due diligence process that happens. A lot of that is a physical inspection on site. And that happens during the due diligence process. And once we have completed that process and we know this is a project that we want to pursue, that we want to buy, then we begin, we finalize our acquisition process. So we put this project out for investors. It's a first come, first serve process. Investors raise their hand, say, yes, I'd like to be in this project. We fill the project up, and then we close on it. So work with our lender and our legal team and our property management team, close on the property. Yay, big celebration. We close the property. We're all now owners of a new apartment complex. So that's great, but it's really just the starting line, right? So that's the start of the race. And so at the acquisition, now the business plan begins unfolding. We're going to start to optimize this property. We have a pretty comprehensive set of tools that we use when we take over a project. Some of the obvious things are that we are going to many times do a rebrand of the property. And that's actually probably simpler than it sounds. We're going to get a new big monument sign that looks great with a new name and a new design. So we let the world know that We got a new sheriff in town here. We're going to paint the exterior. We're going to do landscaping updates. We're going to put up new building signs with the new branding. This is going to give it a fresh look and feel. So we're going to go in and optimize the look of the property and the exterior as quickly as possible. We're going to do an office renovation many times, maybe rearrange the office, create a new, fresh concept for the property. Because again, a lot of these properties, 1970s, 1980s construction, they haven't seen a breath of fresh air in a while. So we want to come in, give it that breath of fresh air. And so we want to do that immediately on the exterior. At the same time, we've got access to a few units that we're going to begin turning. So a unit, and we got lots of pictures here, so I'll show this to you later, but on an interior of the unit, we might put in new flooring, new paint, new fixtures, new cabinets, countertops, etc., to make the property look really nice inside. So that's kind of part of our physical optimization of the property inside and out. And then we've got some operational optimization too, right? There might be contracts that we can negotiate. We might be able to use some of our economies of scale because we own our management company to drive costs down. That's the name of the game here. Is we want to improve net operating income. That's the whole goal of our operation, is to improve net operating income and improve performance for investors. We exist because of investors. So our whole focus is improving performance and returns to investors. So we've got our whole optimization process that happens. Most of that is within 12 to 18 months after takeover or rebrand and doing all our construction. And we get this thing really finely tuned and running well. And then we come to number 4. Distributions. This is the part that counts for you guys, right? We're going to be sending out distributions usually on a monthly basis and typically very soon after closing. We're targeting projects that already have a strong in-place cash flow to be able to pay these distributions. So most of the time we're sending out distributions very shortly after closing, sometimes immediately after closing. And so those distributions come out monthly. You get an email notification from us that, hey, DJE has just sent you $1,000 distribution. That's great. And we do that for the life cycle of the project. We send out these monthly distributions. We also send out updates every month. Hey, here's what's going on with the office remodel. Here's what we did adding an amenity to the property. Here's a before and after on some of the units that we did. And again, I'll jump into some pictures here in a little bit. So people, the investors like to follow along and kind of keep tabs on the progress of the property. Because that first year, we're doing a lot. We're really changing the look and feel of these properties. Then at some point, we go full cycle. And that's what we're going to talk about, a couple of full cycle deals today. Full cycle means just what it sounds like. We went all the way around. We went from actually identifying and buying it through our business plan to the exit. We sell it to another investment group. And then we're done with that project anyway. We send our return of capital to investors. So if somebody put $100,000 in the project, they get their $100,000 back, plus the gains from the disposition. And we'll talk about our typical return profile here a little bit later. But that's the high level overview of how this whole thing works. And frankly, it's not much different than, if you hear talk about a $20 million apartment building, wow, that sounds like a big project and intimidating, but it's fundamentally the same as buying a rental house, which many of you may own or conceptually be aware of, but you're going to look for it. You're going to buy it, make your improvements, put a renter in there, have cash flow, and someday you're going to sell it for a profit. That's all we're doing here with the apartments. It's just bigger, more dollars, more people, but fundamentally the same process. Rental income comes in, you got some cash flow distributions, and then someday you sell it for a profit. That's all we're doing here, just on a bigger scheme, bigger scale. So we'll move on here. How we do this, again, I mentioned the acquisition process. We're looking for B and C class multifamily. We do our exhaustive due diligence process. Then we take over, we implement our business plan. Business plan consists of making those capital improvements I mentioned, and we bring in a management company. These days, we bring in our in-house management company. In the early days, we had third party, but now we're big enough to have our own management company, which really helps us with the control and the speed of execution and making these assets look really, really nice, make them nice places to live. 3, passive income. We're sending out monthly distributions. 4, we're increasing value, adding amenities, doing community development, improving operations. And then again, we're disposing of the property somewhere usually in that 3 to 5 year period after we buy it. We're going to sell it. And then we're going to return principal to investors plus the additional gains. So fairly straightforward cycle there. This is an example of a kind of a typical return profile that we target. This is what we want to be able to hit when we're looking at projects. So if a project can't do this for our investors, we're going to take a pass on it. And we look at a lot of projects to be able to get this. But let's look at investor return projections up top. Cash on cash return, we're targeting just 7% across the board there. And then cumulative return, you got 7% per year compounding. And the average annualized return while we're holding it is about 7%. However, I mentioned at sale, you're going to get some gains on the back end. So what does that look like on a sample $100,000 investment? Well, you might put $100,000 into a project and receive $7,000 per year as monthly distributions so that it would be spread out over the year. But then at the end here, this is where it gets exciting. Your cumulative cash on cash is $35,000. So you've got that $7,000 over those 5 years. But then we've got some equity at sale of another $55,000. And then we return the capital. So really $100,000 turns into $190,000. That's the big takeaway. That's why it's highlighted here, bottom right, is that's the kind of return projection that we're targeting, is something where we can take $100,000, turn it into $190,000. Some of that gain comes through cash flow over our hold period. Some of that gain comes through our disposition and our profit at sale. So that's what we're looking for. In general, that pencils out to a 15 to 20% average annualized return. And when you think about your investment vehicle options, right? You got stocks, bonds, CDs, whatever your traditional investment options are. A 15 to 20% average annualized return, pretty darn good. And then it gets even better when you consider the risk adjustment, because you might have a risky investment pay out a lot. You might have a risky investment pay out zero. Real estate tends to be a very stable investment vehicle because it's a real thing. This is a tangible asset, right? It's a building, it's bricks and sticks, it's an income stream, it's a tangible asset. And that's why we like it, because it's steadily performs and it doesn't see the kind of volatility that a lot of other investments see. So it's generally considered multifamily to be a relatively safe harbor for capital, while you can have some nice growth projections in this 15 to 20% range, which is fantastic return on capital. Okay, let's dive into some real deals here. Let's talk. We're in San Antonio. As I sit here in my office in San Antonio, this property, Nexus, is probably 3 miles east of where I sit. It's right by our office. And this property was a beast. I mean, you honestly felt really bad for anybody that was still living there. It was a disaster, deeply distressed. But obviously, you can see from the photo here, it's a very nice property. Turned into a wonderful story here, both for the community and for DJE and for our investors. So it's really, I talked about win-win at the beginning. This is an example of that, right? Win-win. Everybody involved wins. We won, the neighborhood wins, the investors win, and the residents win. They got great community to live in here. So this is a 75-unit asset we purchased in May 2017. Real piece of work. I mean, just disastrous. There's just a criminal element living on site. It was half empty. The owner wasn't spending any money, which is kind of common sometimes. The owner just stops spending money and it just goes into this death spiral, right? The property was just really in rough shape. So we renovated this entirely. We painted the outside. We put up these nice fences here. We put up solar screens. We completely renovated the interiors, renovated every single unit, probably went a little over the top with granite and stainless appliances, made it absolutely beautiful. This is actually the project that all the brokers point to now in this area as being like, wow, this is what's possible with these apartments if you buy an apartment complex. This is an example of the interior, just a beautiful interior. You can see new cabinets there, granite and stainless. I mean, just a gorgeous unit. I actually staged that unit myself there. Not a bad job. I don't do any of the staging myself anymore, but that's my handiwork on that staging there back in 2017. So we held this asset for 25 months. We spent over $1 million on renovating this property, and we actually took it down to one resident. We cleaned this whole thing out. It was such a mess. We had to clean this whole thing out, and then we fixed it all, leased it all back up, and got it actually up to a 99 and 100% occupancy before we sold it. So full gut interior renovation down to the studs in some cases. Took about 18 months to get through all those renovations. And you can see the gorgeous outcome here. Stainless appliances, granite countertops, backsplash, tile shower surrounds, high quality vinyl plank flooring. Just really, really gorgeous. Look at that shower. I mean, that is looks like custom home there. So that's kind of the before picture, right? This is what it looked like when we bought it. You can actually see this for anybody that's in San Antonio. You could see this project off of I-35 in between Rittiman and Eisenhower. It's on the west side of 35. You can see the property right off the highway there. Pretty beat up driveway there. It's kind of tough to drive through. You see plywood over the windows. You got mismatched paint everywhere. This property is pretty old to begin with, 60s vintage. And boy, it looked every day of it. So we went in there, put private yards in, whole new parking lot, new branding and signage, plumbing, full exterior paint, solar screens, and then some. Rebranded all that stuff. What was this called? The Oaks at Terrell Hills. It had been years since I thought about that. Turned into Nexus Urban Living. So there's a nice before picture. There's the after. And this was just doing the parking lot. We hadn't even touched the buildings yet. They look pretty dingy there, but new parking lot, fresh coat of paint there, really liven things up. You could see 35 on the right there. That's right off I-35. There's some of the exterior before pictures, pretty rough looking. And there's some of the after. So we got paint, and we're actually kind of in the middle. You can see the doors are taped off for painting there. So that's kind of in the middle of our paint scheme there. That's what I'm talking about. This is what the units look like on the inside. They were really beat up. And again, we touched all of them. We went in there and renovated these things entirely. We bought this thing for $2.4 million. That is incredible. I mean, that's mind-boggling for me to think that we bought it for so little, especially today. I mean, prices have appreciated quite a bit. Physical occupancy, meaning how many people were there, was 65% full. How many were actually paying was only 40% full. We got occupancy down to 1% and as high as 100%. So we sold this in 2019, total return of 55% to investors. So 55% return on their capital, at an annualized return of 25%. So on this deal, we're targeting a 20% annualized return. We beat that. So investors were very happy. We didn't actually go the full 5 years. We probably could have, but we went for a shorter period of time and achieved an average annualized return of 25%, which we're really thrilled with. And investors were happy about that too. Beat our projections, and a 25% per year return on your money. And that's to the investors, right? That's not the whole deal level. That's net to the investors. So if I could park my money in deals like that, I would do it every day of the week. We'll jump over now to Legacy. This is another San Antonio deal. This is a project kind of on the north central part of town. I think it's called Uptown in San Antonio. We purchased this as a 106 unit, all bills paid property in March of 2018. We rebranded the property, no surprise. And we also actually converted it into 130 units. It's crazy. This thing was built in the 70s as 130 units. And somewhere along the line, somebody converted it into 106 units. I think because they wanted to get some of that Section 8 money, right? They want to get some of that government money. And there were a lot of Section 8 tenants there, which can be a rougher property to run, can be. So we went in, rebranded it, did our look here. I mean, you could see our vinyl plank flooring, our two-tone paint, fixtures, put in black appliances. We didn't go as over the top on this one as we did on the previous one. A lot of times granite doesn't make sense in these projects, but we made it look nice, rebranded it. And the big one was, hey, it was 106 units that we converted back to 130. So that was a nice turnaround project there. We took it from a self-managed state where you had a family that was managing it to bringing in a professional management company to run it. The property when we bought it was paying all the utilities to the tune of over $200,000 per year in utilities. That's a big expense line item, right? Big expense line item. So we turned that to where the residents were paying their own utility bills, and that helps lower the utility bill because once somebody's on the hook for paying it, they're going to consume less. So there's kind of a positive environmental impact there as well. But what we did was instead of renovating a unit and raising rent, we basically kept rents almost the same and said, hey, you can move into this nice renovated unit, same rent, you have to pay your utilities. And so that's effectively how we raise rents without actually raising rents. Because all that matters is what trickles down to the net operating income, right? That's the name of the game, is improving net operating income. So that's how we accomplished a lot of that, was to take that utility expense, shift it over to residents, reduced overall usage, which is great, and improve the performance financially of the property. And then, of course, I mentioned taking it from 106 to 130 units. That's a pretty nice value add there. We spent over $1 million in capital improvements and added those 24 units to the property. So that was a fun project. Some of the upgrades that we did might be familiar at this point, but we did a floor plan reconfiguration. We replaced all the flooring. You can see kind of this linoleum flooring there is pretty dated. This is like a before picture that you're seeing right now. We like to replace it with vinyl plank flooring. It looks good. It's sharp. It's real durable. It's easy to replace sections of it. Wall and ceiling repairs. We replaced the cabinet hardware and painted the cabinets. We didn't replace all the cabinets in most cases. We wanted to stay on budget here, so we just painted them and put on some nice cabinet pulls. Resurfaced kitchen countertops, resurfaced bathroom countertops and tub, resurfaced the sinks, replaced HVAC as needed and plumbing as needed. And then we put in new blinds, lighting fixtures, and doors as needed. So really just kind of dressing it all up. And it's not that much to do. We might spend $5,000 or $6,000 in a unit, and it looks like a brand new place. So very impactful renovations that we can have there. There's kind of our project in progress. Got to tear it all. You got to tear it all out first before you can make it pretty. So we tear it all out, make it nice, and redo it. So common area upgrades included installing solar screens. These are nice dark screens that go over and basically keep you from seeing inside a residence unit. Looks much more uniform outside. We painted the playground, added mulch, upgraded the pool area and laundry rooms, and we did office remodel rather. The office was in pretty rough shape when we first took over. And then on the exterior, we did general building repairs. We did not paint. Sometimes you paint the whole building. Sometimes you don't have to. In this case, we did not. I opted not to. The roofs were inspected, cleaned, and sealed. And we replaced some of these balcony roofs with nice metal for curb appeal. This is an upgrade kitchen. So again, we didn't go crazy here. We didn't replace the cabinets. We just painted them and added some cabinet pulls. We didn't replace with granite countertops. We just resurfaced and added some black appliances, but it does look sharp and clean. And we could do that at a relatively reasonable budget. Because again, we can only improve as much as the market will support it, right? In this market, we were not going to do stainless and granite and all that stuff. It just wasn't really called for and wasn't necessary. So we're looking for clean, functional upgrades here, and that's what we did. Some of the metrics on this deal. We purchased it for a little over $5 million. We spent over $1 million, and it was 91% occupied. And we actually took that down quite a bit because we turned over a lot of that project. And then we sold it 96% occupied for a total return of 53% to investors. Average annualized return of 23%. We were thrilled with that. Again, 23% a year on your money. That's, you're going to double your money in 4 years doing that. We were really excited about that. And again, that's net to investors. So we held this for 2.3 years, and we're very pleased with our 23% average annualized return to investors. And look, a lot of this is community improvement too, right? We're taking this property that's been mismanaged, turning it into something that is a clean, functional space for families to carry out their lives. And we're proud of that work. We're proud of having that impact. So it's a win-win-win. We win as a firm, investors win, community wins. Okay, yet another case study. Let's jump in here and talk about a property in Guadalupe County. This is in a town called Seguin. I really like Seguin. Seguin has grown a lot. It's kind of like in between San Antonio and Austin, a little bit over to the west. A small town. We had a lender out of Chicago. They kept calling it Seguin. So this Seguin deal, we're going to finance the Seguin deal and some of you guys on here are from Texas, so you might know Seguin. I like Seguin. I wish we could buy 10 more apartment complexes there. There aren't any. There's like 7 of them, and they're all full and nobody's selling. So we were fortunate to get this deal. This is another distressed deal, meaning that this thing was pretty beat up. So it was called Fairway Manor when we bought it. It was a 128 unit asset in Seguin, Texas. Bought it in 2018. They hadn't done much with it over the last 5 years. These guys that owned it, God bless them. So occupancy was at 75%. You can't really make a lot of money on apartments if you're 75% full for a long time. It doesn't really work. You need to be more full than that. So we got a deal on it because it was kind of beat up, and that's all right. That creates opportunity for us. So we bought it at 75% occupancy. We rebranded the asset to the 1048 Modern Living. Super creative name I came up with there because the address is 1048 Country Club Drive, which is kind of funny because the golf course was defunct, right? Like whole golf course out of business, and it was on Country Club Drive. So I always got a chuckle out of that. But the 1048 I thought was a good name for it, and started to execute our value add strategy right away. So we jumped in there. Oh, this is one of my favorite units here. Like this is what some of the units look like when we take over, right? Somebody had gone to town here with looks like different paint samples, and maybe then maybe they had some sort of a drug induced craze or something. I don't know how you get a unit to look like that, but that's okay because there's if we got the budget to fix it, this stuff's relatively easy to fix. It's just sheetrock and paint. We spent over $1 million renovating this project. We renovated 75% of the property's interiors, getting close to $100 rent premium. So if something's renting for $800 before, now we're renting it for $900. So we got some nice rent premiums there. The interior renovations, kind of a similar story that I've been telling here, but retexture and paint, replace fixtures, replace flooring with vinyl plank, new appliances. We're not really dealing with, multi-million-dollar luxury home construction here, right? We're really just kind of putting in paint, flooring, and some fixtures, and we're doing the same to all the units. So this is actually a pretty simple business model, which is one of the reasons we like it. Exterior renovations, accent paint on the doors, windows and trim, landscaping, updating the building numbering and signage, adding solar screens, private yards, those kinds of things. This is a nice picture here of one of our units. At purchase, we were getting down to 70% range. We took it all the way down to 55% occupied. Third-party management company came in and started enforcing the rules, just business basics, kind of business 101, property management 101. A lot of this stuff just doesn't get done. So we started enforcing the rules, and believe it or not, it worked. So this is what our kitchen looked like, kind of similar to our last project. Notice we didn't replace cabinets. We just put those nice cabinet pulls on. They're 75 cents in bulk when you buy them online, right? So we buy thousands of them, put them on here, resurface countertops, black appliances. It shows well, looks sharp, but it's not an over improvement. New flooring, painted the walls. You got a nice private yard there that you can see. And you can also see on the right there some of our bright color we used on the door there. So some of the deal metrics, we bought this for $6.2 million. We spent over $1 million. We took occupancy from 70% down to 55%. And at sale, we sold it in August of 2020, 50% return, a 19% average annualized return. We got up to 100% occupied at one point, and we held this under 2 years. So really 1.79 years. Didn't hold it that long. It's kind of a quick turnaround, right? And that's okay. Most investors were happy. We were happy. And the community of Seguin got a much better operated, nicer looking property out of the deal. So that's kind of what that looked like. So those are 3 projects that we've done in San Antonio or nearby. Seguin's pretty close to San Antonio, where we're able to go in, buy a somewhat distressed asset, create some value, create a nicer product, nicer place to live, get a little bit better rent out of it, improve operations. And at the end of the day, what's the name of the game? The name of the game is, what can we get for our investors? That's the whole business, right? What can we get for our investors, whether that's somebody coming in with cash or whether they're using their Quest Trust IRA to just park some money in a deal and forget about it. Because really, that's kind of how it works. I mean, as a passive investor, especially using an IRA, because the money's coming out of the IRA and the distribution's going back to the IRA, you're really just parking it in the deal and let the person running the deal go do all the hard work. And so that's what we do. We had a number of, I think we had 30 some odd investors on this deal. A handful of those were IRA clients. And so the IRA funds go into the deal. The deal sends distributions back to IRA. Everybody's happy. And people with those IRA accounts, they just go about their lives. They don't have to be on site making decisions about landscaping or managing construction. We do all that stuff. So that's what we do. And we love doing it. We like the business model. We like working with investors. We like IRA funds. We're going to continue to do it. We'll continue to focus on San Antonio. Texas is a fantastic market, business-friendly state. San Antonio is a great market too. It's not as hot as Austin or Dallas, and that's okay. We fly under the radar a little bit. We're perfectly happy with that. I think that kind of concludes the presentation I have here. I wanted to save some time for Q&A, so I'm gonna leave Justin's contact up here. He's our manager of investor relations. You can reach out to him if you like. And I know I've got some Q&A here, so I'm going to actually stop sharing my screen and jump in. And Haley, I don't know if you had any commentary or if I can just jump into some of the questions here.
Yeah, so I know we've got a couple in Zoom, and I actually have a list of my own questions here
right.
listed as well.
Great.
So we'll do the 2 Zoom questions first. I think these kind of came in towards the beginning, and I know you had some slides that covered this in detail, but just kind of summarize, what's the average yearly net operating income, and what's the average yearly appreciation in these deals?
Yeah, great question. Yeah, so net operating income is going to be different on every project. An easy way to think of the easy way I kind of back of the napkin calculate NOI is just to say, what's an average rent? $850. How many units is it? 150 units. Okay, you've got $127,000 in rent per month times 12. Okay, that gives you 1.5 million in kind of top line rent. You're probably running a 50% expense ratio, just as a general rule of thumb. So you're probably looking at about $765K in NOI on that 150 unit property. That's just a ballpark. So if you got a property that's 100 units or 200 units, that NOI is going to change a lot based on that property. The name of the game, though, is to make improvements in NOI. And I just want to highlight something that this question brings up about why we like this business, because these properties are valued on their cap rate. Small changes in NOI have large impacts on valuations. And I'll just give you an example on $1, right? If we can take this property and make it $1 more profitable per year, that $1 of net operating income, well, value is NOI divided by the cap rate. So if we're working with a 5% cap rate, we take that $1 divided by 5%. That's $20 of value. So that's a 20x return on our $1 of net operating income. So you can see how it gets pretty exciting if we can raise net operating income $100,000 on a property over a year on that 5%. That's a $2 million increase in valuation off $100,000 in net operating income. So we love the leverage there that we're able to use. And that's how we're able to get these returns. So that's kind of the NOI question there. The other question was on average yearly appreciation. Appreciation is kind of a weird thing in multifamily because we don't, for the most part, value these large multifamily projects based on comparable sales as much. We really do value them off of net operating income. However, if you were just to say, look at a 3% annual appreciation, just to boil it down to absolute basics. The cool thing is we're not getting appreciation on, we're not worried about appreciation on the whole asset. If you have a $20 million asset that appreciates 3%. Well, that's $60,000 increase, right? In appreciation, just 3%. But we didn't buy the whole thing for 20 million. We're only in it for 5 million because the bank's got the rest of it. So we're seeing a $60,000 appreciation on the 5 million, and that number's not 3%. That number's 12%, right? So because we're using bank loans and leverage, that little bit of 3% appreciation per year is having a big impact because on our equity. So there's not a standard rule of thumb for annual appreciation. We look, as apartment investors, we tend to look more at rental growth rates, at cap rates. There's kind of a whole stew of things that go in here. But at the end of the day, what matters for the investor is what is our average annualized return on the project? And you could see on those case studies where 19%, 23%, 25%. Average annualized return net to the investor, which we're looking for out of these projects. So great questions.
Mm-hmm. Awesome. Let's see. And this is a good question that just came in here. One of our attendees wants to know, can shorter term deals yield investors the same types of returns?
Yeah, it's a good question. Normally on these apartment projects, you've got at least a year to go in and do what you need to do. Now, some projects are really clean and you could buy it. And boy, if you could find somebody to sell it to 6 months later, that's great. Most of the time, that's not how the larger projects work. You're going to go in with a capital budget, fix everything up, and turn around and sell it. I think there's an argument to be made for shorter and longer. I mean, shorter, if you've done and made all your value creation and you can sell it and get the investor returns in 2 years, great, do it. But you're going to reap some benefits of appreciation over time just by fixing it up, running it well, and just operating it and waiting and seeing that appreciation. You're going to kind of win both ways. What we look at it as a firm is, what did we project for an average annualized return to investors? And if we can hit that in year 2, great. If we hit it in year 4, great. It's all about what is that average annualized return we can get for investors. So I don't think there's a rule of thumb on whether shorter or long-term deals have higher yields. Great question.
That was a really great question. It kind of coincides with one of the ones that I had written down as well. How long do you guys typically hold your deals? Are there times that you have held it longer or shorter than intended?
Yeah, that is a great question. So we always say 5 years, and that's pretty standard in our industry. If you look at multifamily operators like our firm, hey, we're going to say 5 years. That gives us time in the first year or 18 months to go in there and do our plan, execute our plan. We've got to rebrand it. We're going to renovate units. We're going to clean it up. That's going to take a year. That might take 18 months. Then we want to enjoy some of that cash flow. Boy, we did all this work. Let's just enjoy this thing being 95% occupied and throwing off some cash flow, and we're not having to do a bunch of work. And so we want to do that as well. And then that puts us in kind of the 3-year range. And if it's time to sell 3 years, great. We're always looking at what average annualized return can we hit for investors. We have not gone longer than 5 years, but we've sold some where we said this is a 5-year project potentially and sold it in that 2.5 to 3 year range. So historically, we've sold shorter. In a shorter time frame. We have not gone longer, but we like to say 5 years because if we get to year 4 and we have another COVID or another economic, downturn or whatever, hey, maybe it's not a good time to sell. Let's just wait a year. Let's just cash flow it. The property's doing well. These properties perform beautifully through COVID. I mean, obviously that was a disastrous year for everybody, but multifamily as a sector did great. And so these things are relatively recession resistant. So if we got in a situation where it was just unfavorable market conditions for selling, hey, just hang on to it in cash flow. You really only, the valuation of the apartment complex only matters when you refinance or sell. Otherwise, you're just holding it for cash flow. Mm-hmm. Great question.
Nice. Great information. And another question that just kind of popped into my mind. So I know like the single family market right now is insane. A house goes on the market, there's 50 offers, there's bidding wars, things like that. How does the multifamily industry kind of compare to that right now? Is it really competitive to try to find these complexes or deals when you're ready to sell? Are there people lining up ready to buy it? How's the difference compare there?
It's definitely competitive in San Antonio right now, and it's certainly heated up. Now it's completely different in single family in that you have to have a very sophisticated buyer. In single family, kind of anybody can qualify for a loan. You have a whole bunch of buyers. Many of them are going to move into it themselves, owner occupied. And you got some investors. On a 10 or $20 million building, you have much fewer buyers, but you still have buyers, and it is competitive. Part of the reason is supply, right? If you look at the number of homes built every decade since the Depression, it's really high. And then if you look at the number of homes built from 2010 to 2019, it's as low as it's been since the 1930s. We didn't build enough homes in the last 10 years. Everybody got scared in 2008, housing crash. America did not build enough housing, and that includes multifamily. So you got a supply constraint, your basic economics 101, supply and demand curve. If your supply is limited, your price is going up. We're seeing that on single family. We're seeing it on multifamily too. One of the reasons we like this 1980 stuff is you cannot recreate it. You cannot build it for as cheap as we're buying it. And you can't build it somewhere, interior of the city, close to downtown. There's nowhere left to build. So we're buying irreplaceable assets. So yeah, it's competitive out there for sure, which is where, this is a completely unfair game. It's where operating and having for us, we're in one market. We get to look at deals a lot of times before anybody else does. And so that helps us. We've got an unfair advantage there, but it's definitely very competitive in the multifamily space.
Mm-hmm. Definitely. It's crazy out there, but great answer. That was really interesting. I have a couple more questions for you. These are actually my own questions that were sparked during your presentation. You talked about you guys operate your own management company to kind of reduce costs there, things like that. Have you always done this? Did you get to a point where you realized, hey, we need our own management company? How did that kind of work and evolve over the time that you've been investing in these deals?
We started it a couple of years ago because we were big enough to be able to do it. If you have a couple of properties, it's hard to justify owning an entire management company because there's costs and associated with that. So as a smaller firm, it makes sense. It makes sense sometimes to use third-party companies that have all that built already. We just got to a point where we'd done enough. We had a big enough portfolio. We frankly had a bad experience with another management company and finally said, we're paying enough out in fees. We could just do this in-house. And then for me personally, it was all about the person, right? It was about finding that superstar that could build that and run that company, and was fortunate enough to have that happen. And so we started the management company. Management company isn't really like a big profit center for operators, but if it gives you more control, it's all about improving that net operating income. So if your management company just breaks even, but you have better NOI, that's a win. And it helps us just execute better, faster, keep it all in house. We're our only client. We're not out there running 1 million units for everybody else. We're really our only client. So we have a nice focus that just gives you more control, which is what most operators will say once they get to a certain size. You want to have that control.
Mm-hmm. Definitely. Great information. One of our attendees wants to know, how do you get to look at these deals before everyone else?
Great question. Multifamily is a small world. There is not really an MLS per se. So if I go to, you're going to go list your house for sale, it's going to go on this market. Every real estate agent's going to see it. And that's how that works. Multifamily is a much smaller set of players. And if I'm a seller, the idea of putting it out there and having 1 million tours and everything, it's sometimes not as palatable as saying to my broker, hey, find me somebody that can just for sure close this thing and not mess around. Because these are long sales cycles, they're complicated transactions. You don't want tire kickers. You don't want unknown quantities. So our firm at this point is very well established as a closer that doesn't mess around. And a seller a lot of times would rather just work with a firm like ours that says, okay, these guys are going to close, are going to do what they say. And it's easier for a seller sometimes to just do an off-market transaction. Again, totally unfair, right? This is an unfair advantage that we have, having been in the marketplace and developed the relationships long-term.
Mm-hmm. Nice. And just a couple more questions for you. Now, obviously, with things being competitive right now, like inflation, they're not building more of these Class B and C apartment complexes. Have you changed your business plan or strategy for any of the new deals that you're acquiring this year? How has that evolved as life has just changed in general in the last year? Kind of walk us through that a little bit and how you're planning and strategizing moving forward for your new deals from here?
Right. It hasn't changed as much as you'd think. Really, we're just looking for properties where rents are lower than we think they should be. And we can say, hey, I mean, it's almost like kind of boring operating the same market. Like, oh, well, we're looking at this deal. We own the deal next door. My buddy owns the deal across the street. I'm a partner in this deal. I know all these deals. I know all the management companies on them. I know what we can do on this property. And it's just executing on that specific market knowledge that we have to say, they're running it at this. We know we can do it at this. Let's go ahead and buy it and take it over and execute that plan. And so that just gives us a confidence level. But the business plan hasn't really changed that much. I mean, we're going in, we're trying to get it at the best price we can. We're doing our rebrand and pushing rents. And that, frankly, that's it. You know, I will say interest rates were lower, this year, which helped some deals get done. There's always kind of some variables in the acquisition process there that are always changing. But fundamentally, our business plan hasn't changed, even though the world's changed a little bit. The bottom line is people need a place to live. There's not enough of this supply of housing.
It's so true. So Devin, this has been a great presentation. It's been great to kind of get an insight to the types of deals you guys are doing and the things that you look for as you're improving net operating income and things like that. Now, if someone wants to reach out to you guys, if they have more questions, maybe they're interested in learning about what types of deals you guys have going on, how does someone reach out to you? What's the best way for them to get in contact with you?
Sure. We got a lot of content out there. We're big. We're big on education, just like Quest is. The best way is to go to DJE Texas, Delta Juliet Echo Texas.com. You'll see a button right there to schedule a 15-minute call with us. And that's probably the best way. That's going to establish the relationship, which is important. That's going to let us send you case studies, show you information, answer any questions for you, meet the team. All that stuff can be done. And I really, want to stress that education is the first step for people, just like you guys do. You want to get educated, you want to get comfortable so that you can do intelligent due diligence so that when a deal comes along, then you're prepared. And if it's not a fit, don't jump into a deal early, like get educated and keep fine tuning that. We're big on that, just like Quest is. And so you can go to the website, set up a call with us. We'd love to continue that education process for people.
Definitely. Yes. I love that. Education is so important. Even if you're not quite ready to jump in right now, prepare yourself with the tools, the knowledge, and the right resources. That way, once a deal does come across your plate, you're ready to go and you're not starting from square one. I love that you touched on that because I think that's so important as well. And again, guys, that website, I did put it in the chat for everyone. It is djetexas.com. Devin, before we sign off for the day, do you have any last kind of closing thoughts or piece of advice for our audience out there?
There's an old adage in real estate. The best time to buy it was 20 years ago. The second best time is right now. And it feels like, wow, the prices are getting high and they are, but we're in a supply constrained situation, right? And that's really what's driving a lot of this pricing. So, feels like things are at high prices now. I think we're going to see a lot of inflation in the future. We still have supply constraints. Construction costs are going through the roof. I'm very bullish about multifamily. So wish we bought all this 20 years ago. We couldn't. Next best time is to be doing this now. And I would just say, everybody on the call, you have educational resources at your disposal that just did not exist even a few years ago. So take advantage of those, get educated first, and then you can take effective action after that. Awesome. What a great last point to wrap it up for the day. Devin, thank you so much for taking time out of your schedule to come join us. Remember, guys, if you want to rewatch today's presentation, as well as all of our other classes, be sure to check out our YouTube channel. You can find everything right there. Rewatch them, tell your friends about it, do all those fun things on YouTube. That really helps us out. So Devin, thank you for joining us today. And I hope to see you guys in some of our other webinars that we're hosting later this week. Thank you so much for having me, Haley. I enjoyed it. Awesome. Thanks, Devin. See you later.